Okay, well, thank you very much. It's very good to be here. And the project has come a long way since we first met. Um, and so we have recently announced the results of our pre-feasibility study, which is a major step forward for our company. And also, since we first met, we did form a joint venture with Mitsubishi Corp, with the division of Mitsubishi Corp that is the largest commodities trader in Japan, and they've got a raw materials division that likes to get involved at the development stage of a mine. And this is a model they've done successfully 10 or 11 times, I think, around the world. They get involved at the development stage and they help to get the mine built. They like to end up with 20 or 25% interest in the mine. They don't want to operate. They just want their share of the offtake or more if they can get it. So it was very exciting to get involved with them about a year ago. And then, with them, we have prepared this pre-feasibility study. Standard disclaimer here. So we formed a joint venture company. This was the structure that Mitsubishi wanted. It's a good structure. It's called Hard Creek Nickel Corp, which used to be the name of our company. And Mitsubishi owns 15%. We own 85%. And just here's some of the highlights. So yes, a very big project. Approximately, for most of the years, I think 28 years out of the 30 years of mine life, we have 35,000 tons a year of nickel being produced and 2,000 tons a year of cobalt. That is a giant mine, and it's a 30-year mine life. This is producing an extremely high-grade concentrate. The capital cost to build this will be $1.9 billion US dollars. Now, just to put that in context, our real competition for supplies of nickel is coming from Indonesia in the form of high-pressure, high-temperature acid leach projects that mine laterite. And for them to get to a similar rate of production, call it 35,000 tons a year of nickel, their capex is about $3 billion US. So although these numbers are eye-watering, this capex for this kind of production is quite competitive. One of the things about this project that is a real strength is the simplicity of it. 99% of our nickel and cobalt are contained in one mineral called pentlandite. It's a sulfide mineral. And so really, all we have to do is float pentlandite and suppress everything else. Crush it, grind it, float it. This looks very similar to the flow sheet for a copper porphyry mine, except it's even simpler than the typical copper porphyry flow sheet. But any copper porphyry miner would recognize this flow sheet. In the PFS, we did a very successful geometallurgical program that I believe we're talking about a little later. It just allows us to predict with a much higher level of accuracy how much nickel and cobalt we will recover from any given block of ore within this giant ore body. And we make this lovely concentrate that we model selling to a smelter. It would be a premium product for a smelter, but it's also extremely amenable to what's called pressure oxidation refining. And that market, the pressure oxidation refinery market, there's a few of them around the world, but it's not yet developed to the extent that we think it will be developed in future. And the reason we think that refinery market is going to be developed is because it's a much more direct route to the cathode. It's a much more efficient route from our concentrate to the cathode. And so we just think it's inevitable that will develop. It's not yet developed. That's why we didn't model it in this engineering study. We've got a very low strip ratio, 0.4 to 1, life of mine, that is a huge advantage. And this will be a very low carbon operation. We modeled in the PFS 1.8 tons of CO2 per ton of nickel produced. And that's using a diesel mining fleet. We have not accounted for what we think will happen over the next few years, which is that all electric mining fleets will become available. They're not yet available, at least in the size that we would be using. And also our tailings will sequester CO2 out of the atmosphere, which is measurable, and that will add to, we think we're going to get to carbon neutral or better with this project. The PFS economics are positive. And again, for context, when you see an internal rate of return of better than 10% for a large, long life base metals project, that's kind of the hurdle. And the fact that we've got there using an extremely conservative PFS is excellent. And this PFS, by the way, is targeted to the strategic market. We are talking to car companies, battery companies, and large mining companies. And we created a document that is credible. In other words, it's one that they will believe. Now, the nickel price we use for the economic analysis, $9.75 a pound US, that is 19% below the 20-year average nickel price in 2023 dollars. The nickel payability, 78%. Those are typical smelter terms for a product like ours. And actually, as the price of nickel goes higher, the payability goes higher too, because it's really reflecting a treatment charge. We used a discount rate for our depreciated net present value of 7%. Most people use 8%. The reason that the engineers felt that it was reasonable to use 7% is that, you know, our partner is Mitsubishi, and Mitsubishi has a couple of mines, or pardon me, a couple of banks within their, you know, sprawling conglomerate. One of them specializes in mine financing, mine construction financing. And so, you know, we've got, we will ultimately, if this mine is built, have access to, you know, funding at more like maybe 2 or 3%, which is remarkable. So the engineers felt that using a 7% discount rate that rather than 8% was reasonable. Now, one thing you might notice is that the post-tax internal rate of return at this price is higher than the pre-tax internal rate of return. That is an unexpected result. I was surprised when I saw it. And the reason is that the Canadian government has introduced the refundable clean technology manufacturing investment tax credit. And that actually supplies cash back as you spend to build this type of critical minerals mine. The sensitivity is quite extreme to the nickel price. So if you take the nickel price higher, we've got a sensitivity analysis here, plus 15%, minus 15% from the base case. And so the high price case is still below. I just want to emphasize this, the long-term, the 20-year average nickel price in 2023 dollars. And you can see how the net present value, you know, goes much higher very quickly as you do that. In the low price scenario, this is kind of interesting. If you take the price down by 15% from the base case, we end up with the post-tax depreciated net present value of 21 million US dollars, which is about what our market capitalization is right now. So if you believe that the long-term price for nickel over the next 5, 10, 15, 30 years is going to be $8.29 a pound, then our stock is fairly priced. But I would also suggest that if you believe that, you shouldn't be looking at the nickel market at all. None of us believe that. And none of us, frankly, and none of the strategics that we're talking to care about the nickel price today or a year from now or 2 years from now. What matters is where we think the price will be 5, 10, 15, 30 years out. This is a mining jurisdiction, and it's a good mining jurisdiction. We've got very high standards for environmental assessments. We are in what's acknowledged as joint Tahltan and Cascadena territory. They both claim traditional use in this area, and there's broad agreement that this is, going to be a project whose benefits are shared by both the Tahltan and the Cascadena. So really a good jurisdiction. Here's our mineral resources statement, and again, it just says huge. But also, for the first time, because we've now because we're now in the process of publishing a pre-feasibility report, we've got reserves, and our reserves total 950 million tons in both proven and probable. So that's a major milestone for this project. There is a ton of exploration upside still. This entire ultramafic complex stretches about 8 kilometers end to end. And you can see in the Horse Trail Northwest zone, that is where we are modeling our mine. But we've got exploration potential outside of this. And in fact, volumetrically, we think that what we've drilled off here is, less than 20% of what we think is prospective. So for example, up in the Highland Zone, we've got a number of holes, and that's 3 kilometers, maybe 3 to 4 kilometers away from where this open pit will be. We've got holes that are very similar to what's in our current resource. And similarly with the Davis, the Central, the Mandible, Hatzel and Duffy. Well, Duffy will be mined according to this mine plan. Hatzel, which is on the other side of the Turnagain River, does not get mined in this current iteration of the mine plan, but it will be mined at some point in the future, we believe. And then the Cliff Zone is quite interesting. It's got lots of nickel, but it's also got elevated copper, platinum, and palladium. So it's more of a polymetallic area. And, we've never really had a budget to properly drill off this entire ultramafic intrusive. We've got very, very interesting results from all of these areas. And then that ridge zone between, where our open pit will be and the Highland Zone, completely unexplored. So just tons and tons of upside to this. A 30-year mine life, we believe, is an initial mine life. I talked about the simple flow sheet. This is, it doesn't get simpler than this. And so compared to other, large Canadian sulfide nickel deposits that are open pittable, that are low grade and open pittable, similar to ours, this is simpler than all of them. We don't require desliming circuits because we don't have the type of alteration that requires that. We also don't require magnetic separation circuits because we don't have any awareurite mixed in with our sulfides as the other competing projects do. Now, when I say competing projects, there's such a voracious appetite growing for nickel for the EV business, just in North America alone. I think all the projects are going to get built at some point here. Our concentrate is absolutely beautiful. So multiple, hundreds of metallurgical tests. We get a range of 15 to 21% nickel. We think we can consistently produce 18% nickel concentrate, and the deleterious elements such as arsenic, mercury, and cadmium are extremely low. So suitable for smelting. And in fact, if you're a smelter, I think the typical concentrate that's sold to smelters these days is on the order of 10% nickel, ranging down to 4%, maybe up to 12%. And so these lower grade, dirtier concentrates, you can, if you're a smelter, probably pay less for them. And then whatever problems you've got with that feedstock, you can blend away with a product like this. But again, this is a very suitable product for pressure oxidation. You could take this to MHP, you can take this to sulfate, you can take it all the way to metal, actually, with the refinery. It just depends what you put on the back end. And and if you create MHP, we've done test work on this, you will create a better quality MHP than what they're producing out of the HPAL projects in Indonesia, just because it's much lower in impurities, because you're starting with something that's much lower in impurities. This just shows our projected yearly metal production. Green line is nickel, and the blue line is cobalt. I think this thing's probably already out of date, but this is just some of the announced gigafactories in North America alone. And it's estimated that 250 to 450,000 tons a year of new nickel supply is needed for these factories. And that range depends on how much of it will be LFP and how much of it will be nickel-based chemistries. Recent information I've seen is the nickel-based chemistries will dominate in North America. LFP will be a player for sure. It's an excellent technology, but it does not have the range that nickel-based chemistries have. And there's very little currently produced in North America. Not nearly enough for all the demand that's coming at us. The Inflation Reduction Act is very supportive of projects like ours. And there's also, the U.S. Department of Defense is very interested in helping develop strategic supplies of minerals, particularly in North America. And the demand impact from the IRA is significant. Worldwide, I mean, look at this. This is incredible. 3.3 million tons a year of increased nickel demand just for batteries between now and 2040. That is 120 new large nickel projects that would be required worldwide to meet this demand. And by large, I mean similar in size to the Turnagain project. I don't know where all those projects are, but I know where one of them is. And this is interesting. So nickel prices, have historically been quite volatile, and every once in a while they go crazy. And this is why, getting back to our 11.4% post-tax, internal rate of return, that's why that is acceptable for large, long life projects like this, because you make decent money at that rate. But every once in a while, with a commodity like nickel, it'll go crazy in price for 2 or 3 years, and you will just make so much money in those 2 or 3 years, and then you'll go back to making, a decent return. My question is, can we get this thing built before we see the next spike? Because I feel like one is brewing, because you've got this whole new source of demand for nickel that is rapidly overtaking demand from stainless steel. So our main competition, what is now the largest producer of nickel in the world, is Indonesia. And these are all laterite deposits. So, a big comparison is that we will be building a large open pit mine. Now, it's a major impact. It's going to be, 2 kilometers or so, 2 by 2 roughly, but deep. And so relative to the amount of rock you're moving, the surface impact is small. With laterite projects, the ore body is maybe 10 meters thick. But it goes on and on and on, kilometer after kilometer, mile after mile, in most cases through tropical rainforests. And so they're mowing down tropical rainforests to get at this clay and dirt, to get at the laterite nickel. And so the deforestation, the destruction of habitat, the destruction of species is incredible what's going on in Indonesia, all in the name of saving the planet. It's unbelievable. And quite often they're dumping their tailings directly into the ocean. There's all sorts of spillage into streams that then run down onto coral beds. And there's, this is the coral triangle. It's one of the most diverse marine ecosystems on the planet. And it's just, well, it's getting wasted. And it's not something, I think, that can remain hidden. This is the modern times. People have drones, people have the internet. I think it's going to become more and more apparent what's happening. And I already know that there are car companies, particularly in Europe, that will not source raw materials from Indonesia. We've designed a very good tailings management facility, safety first. And in our model, we've paid for it. Financially, it's just more expensive to build a tailings management facility as safe as what we've designed. And so this shows you the main dam construction and the way it's built. There's also a plan view of the tailings management facility. And as you can see, there's a small pond in the middle. This is towards the end of the mine life. And the rest is beach. So it's finely ground sand, which is exposed to the atmosphere. And we've done it this way for a couple of reasons. One is to expose as much of the silicates to the atmosphere as possible so that they can suck in CO2. What they do is they absorb CO2 and they convert from silicate to carbonate minerals. And the CO2 is locked away in mineral form for geological time periods, hundreds of millions of years. So we're not storing CO2 in a way that it can possibly escape. It is sequestered. It becomes part of a mineral. This is measurable. We're working with a scientist at the University of British Columbia that's been studying this phenomenon for about 20 years, Dr. Greg Dipple. He's developed a way to measure how much CO2 is being absorbed. And we are working to get this methodology certified so that we could claim carbon credits. And again, the goal is to get to net neutral or even net negative so that we could actually make money from carbon credits. So just in general, sulfides are very low on the carbon intensity. And we've gone from 2.24 tons per ton of nickel, tons of CO2 per ton of nickel in the PEA to less than 1.8 to 1 in our PFS. And that number or that ratio will continue to decline. So plans and catalysts. Now you'll see that a lot of it doesn't have any dates on it because it all depends. It all depends when we get the money. Now that we have released this PFS, it's deal time. We're talking to strategics. We're talking to major mining companies, car companies, battery companies about buying in at the project level. Our model is not to finance development of this project by diluting our stock. Our model is to sell pieces of the project, as we did with Mitsubishi Corp. And we have a lot of interest, obviously. This is perhaps the lowest technical risk large nickel project in the world. And there is a lot of interest. To get from where we are to a final investment decision, in other words, through the environmental assessment, to get permits, all of the resource and geotechnical drilling we'll have to do to get to full feasibility level, and all the metallurgy and engineering and geometallurgy that we have to do, all of that is going to cost about $50 million US, is what I estimate. I'm still waiting for the engineers to come up with their more detailed breakdown of those costs. That'll be part of the PFS. The PFS, as I speak today, has not yet been published. Only the press release with the highlights of the PFS has been published, but I expect that within a couple of weeks that we will put the full pre-feasibility study on CDAR and on our website. So we're looking for $50 million US. We're talking to companies that have the financial depth to afford that, and companies that want to be either exposed to a long-term supply of nickel at a predictable cost, such as the car and battery companies, or that want to be exposed to nickel full stop. I mean, you know, the large mining companies that are currently involved in you know, other types of mining, but are not yet involved in nickel, you know, such as copper producers. This nickel project in particular will look very familiar to them. And I just want to point out to a couple of directors. Martin Vidra, our president, he had a 31-year career at Sherritt International, a Canadian company with a mine in Cuba. And he's an engineer that spent a large part of his career selling various nickel and cobalt products to end users. He is spearheading our discussions with strategic investors. As I speak, he's at LME Week right now in London. And it's just, he is busy, I can tell you that. So, and I give Martin full credit for, you know, bringing Mitsubishi into the picture here. Another director that has a lot of experience with the end users is Bob Morris. About 2 weeks before he joined our board, he retired as a senior vice president at Vale, which is the giant iron ore producer, but they're also a giant base metals producer. And Vale, at Vale, he was in charge of worldwide sales for base metals. So copper, nickel, cobalt, but also, you know, PGEs and gold. You know, it was a portfolio that in value was 5 to 8 billion a year, depending on pricing of commodities. So, you know, he knows all the end users, he knows all the strategics, and they know him very well. We have an excellent internal team for the approach that we're taking to development of this. Here's our capital structure. And I'm going to stop sharing the screen now and open this up to questions.
Perfect. Thank you very much for the presentation, Mark. I think that was a good overview of the market as well of the mine and what's happening in the future timeline. It is 17:28. We still have 2 minutes. If anyone has additional questions, please feel free to put them in the Q&A box or in the chat box. One thing is sure, Mark, when we look at CapEx, such as $1.9 billion, that can make a lot of guys have cold feet. Can you explain us a little more? What would be the strategy of financing such an asset? Let's say the feasibility study is good, environmental, everything follows through. What are the strategy to finance such a big CapEx?
Well, you know, typically it's 60% debt, 40% equity. But, you know, we've got one good partner with that kind of financial depth, and we're looking for one more good partner with that kind of financial depth as well. And that's really Our plan is to go at the project level rather than at the stock level. We think there's such a disconnect between our market capitalization and the value of this project that it just makes no sense to dilute our stock to finance this, particularly given what we've got a market cap, 25 million Canadian, just to get this to financial or to final investment decision is about 50 million US. So what are we going to do? Triple our stock outstanding and add warrants to get there? I don't think so. No intention of doing that. We don't need to do it. We have enough money to last for quite a while. Well, we've got enough right now for more than a year of G&A, and we're just not desperate.
All right. Well, I think this is a good ending sentence. We're not desperate. This is already good. I mean, we're up to the time of 7:30 now, Mark, so we couldn't have stopped on a better sentence. But that's
Julian, let me say this. Let me
Yeah.
say this. We should perhaps make a T-shirt that says that.
I think this is, well, maybe this is a good crowdfunding idea you just got there.
There we go.
All right. So, Mark, thank you very much for presenting Giga Metals. Sadly, the time is up. We will now be moving on to ClimaX. But again, thank you very much for being with us.
Thank you, Julian. It was a pleasure as always.